Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today marks the first day of the last trading week of the first half of 2018, and what an eventful first half it has been. Indeed, both locally and internationally in equity and fixed income markets, there has been a lot of volatility, and overall, markets have been on a downward trend. Let's take a look now at the local equity markets first and see what has been going on. And year to date, the local market as measured by the Trinidad and Tobago Composite Index in this blue line has been down 2.6% as of Friday's close. Now this is in stark contrast to what would have happened at the beginning of the year, where the market would have basically treaded water with not much change up until about the end of the first quarter in March. Thereafter, there was a very sharp decline, and much of this was driven by declines in the cross-listed market, or the cross-listed index, which accounts for about 30% of Trinidad and Tobago's overall market value, which has declined just around 7.7%. Interestingly, the All-TNT index would have posted a modest recovery and is just about flat for the year. Now, as we can see, as we scratch the surface a little bit more in terms of the major decliners and gainers, three locally domiciled stocks, NGL First and Scotiabank Trinidad and Tobago, have been the best performing on the index for the year thus far, with NGL up just around 11.3%, First up 9.1%, and Scotiabank just up around 8.2%. On the other hand, in terms of major decliners, TCL has been down around 20%, NCBFG down around 13%, and one other stock, let me just get it clear, Whitco down around 11.5%. Switching to the international equity markets, major regions of the world have also been on a downward trend. Despite a very aggressive start to the year at the end of January 2018, most markets were up in very high single-digit or low double-digit returns, and that has all turned around in quite dramatic fashion as we approach the end of the half year. Latin America has been the worst faring region, down 14.5%, almost 15% in US dollar terms, on the back of rising geopolitical tensions, political uncertainty, rising interest rates, among other factors. Europe hasn't fared that much better, down just around 5.4%, and Asia, despite being the fastest growing region, is down just around 3.9%. The only the shining light in the international markets really has been the US, and that's up just around 3.3% after being up almost 10% at the start of the year. Turning quickly to local bond markets, and there has not been much joy for investors for the year thus far, as a matter of fact, for the past few years. And this yield curve, the government of Trinidad and Tobago yield curve, has not really shifted at all. In addition, there hasn't been much supply of bonds for investors to participate in. That could be set to change if we are to believe the Honorable Minister of Finance, as the National Investment Fund, which was initially being touted as equity offering or equity type offering, has been said to be issued in a bond offering instead, or a series of bonds to the market. Now, while we await the prospectus for the offering, what has been said in the media and various sources in the media is that it will be in three tranches: a 5-year bond at 4.5%, a 12-year bond at just around 5.5% a coupon, and a 20-year bond that's around a 6.5% coupon. How would this compare with the yield curve right now? Well, at the 5-year point, government of Trinidad and Tobago bonds in TT dollars currently yield around 3.5%. The 10-year yield is around 4.4%, and the 20-year yield is around 5.6%. So the NIF, if delivered as promised, would offer investors a 1% excess return over the prevailing government of Trinidad and Tobago yield curve. Time will tell whether or not this materializes, and fixed income investors would certainly hope to have access to what would be one of the single largest public auctions of bonds in recent history. And finally, in terms of international bond markets, well, it has been a similar trend of downward movement for international bond markets, or the US dollar bond markets in particular. Over the last 5 years, emerging market high yield in yellow and investment grade bonds in blue would have delivered total returns of 15% and 27% respectively, which was quite a tidy return over that period. However, year to date, with continued rising US interest rate increases, the market is going through a period of an adjustment. And year to date, emerging market high yield bonds, their total return has been actually negative 6%, and investment grade bonds has been negative 3%. So overall, as the market continues to adjust to rising interest rates, growing geopolitical tensions, trade tensions, and other factors, there will be some more periods of volatility in the months ahead. With that being said, there's always opportunity in declining markets for investors to grab hold of very attractively priced assets as that opportunity arises. That's it for this week's edition. For more information, give us a call at 226-8773 or to Bourse. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a great investing week. This has been the Bourse Report.